So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth in life so you can give more all of it away to help MVPs. My name is Brett Swarts. Each and every episode, we're joined by some of the world's top entrepreneurs, millionaires, or billionaires, where they share their secrets, insights, and wisdom with us so we can compound and make a bigger impact. I'm excited about our next guest. He's out of Pennsylvania, and he brings over 30 years of real estate finance and investing experience as the chief operating officer of Eagle Capital Investments. And he works alongside his world-class team of professionals. He makes his mission to find great investment opportunities for his clients by helping them meet their wealth and building goals, and so much more. Please welcome to the show with me, Mr. Tom Dunkel. Tom, how are we doing?
Hey, I'm doing great, Brett. It's great to be with you and all the listeners today. I'm looking forward to our chat.
Excellent. And for our listeners getting to know for the first time, would you give us just a little bit more about your story and your current focus?
Yeah, sure. So a little bit about my background. So, got out of business school and headed into mergers and acquisitions in the aerospace industry. So I had a nice run in the corporate world for about 11, 12 years, doing deals, raising a lot of institutional capital, private equity, did some, big debt facilities, acquired a bunch of companies, and I was just surrounded by some amazing people, Harvard undergrad, Wharton undergrads, it's Naval Academy guys. Anyway, just an incredible environment for me to learn as a young professional, how finance is really done, how deals are really done, what to look out for, how to structure your team, all of those kinds of things. So really kind of build a great foundation for me, Brett, so that when ultimately, fast forward to 2006, I get fired from my corporate finance job. I was able to kind of go out and start my own thing, which I had been wanting to do for a long time. And, little did I know, is heading right into the Great Recession. And so learned some hard lessons there those first few years, because, of course, I had the great education, I had the great background. But, when you're out there on your own and you're the guy that has to make the decisions and put the team together and, lead, those are different skills that I didn't really have. So I'm trying to learn those on the fly while the market is crushing me. So it was a pretty challenging time. But, I wouldn't change it for the world. It really kind of thickened up my skin. And now here, 19 going on 20 years later, I've been able to do some pretty cool things in and around real estate. Built a couple 8-figure businesses, and built some teams, made plenty of mistakes, had tons of failures, but had some pretty solid successes as well. So today I'm focused on helping the investor network that I've put together over the years to diversify their wealth into alternative investments with world-class operators that I've personally come to know, like, and trust and invest with over the years. So we call that a fund of funds model, and that's what Eagle Capital Investments is all about.
Awesome. By the way, can you learn more about Tom Dunkel by going to eaglecapitalinvestments.com? It's eaglecapitalinvestments.com. And so, Tom, this is really cool. So you invest with you guys, and you get a chance to get to multifamily housing, mobile home parks, self-storage, medical office buildings, private lending. What have you found is the preferred one in this marketplace, and how are things going?
Yeah, great question. With all the uncertainty right now, are we going to in a recession? Are we not? What's going on with the tariffs? Where are interest rates going? Yada yada. It's a challenging time right now. So I've really settled into private lending as my investment of choice right now, Brett. I mean, I'm still investing in multifamily. I did a deal earlier this year. Still have plenty of holdings in self-storage. But for right now, as far as deploying new capital, I really like private lending because it's secured in first position against a hard asset. I'm getting payments every month. And so I can kind of collect those payments and secure that capital while I'm waiting to kind of see how things unfold in the economy over the next 3-6 months.
Excellent. What would you say is some of the average returns, and then when you buy a multifamily or invest in a multifamily deal, like what are some of your criteria? Maybe you can share the deal that you did recently, because I likewise I found the same thing. We've been in private debt for really like 4 years. Like we stopped buying a while ago, and because the prices didn't make a lot of sense. But I'm curious. What are you, and by the way, at that time it was like 6% was the debt. It wasn't great. And then it got to 10, and then we're getting over 10 now. And it's just it's as rates have gone up, right? So what are you seeing as the average interest rate that you're getting return for the investor or for your fund to fund model? And then also for the multifamily deal that you did, could you kind of break that one down?
Yeah, sure. So on the private lending side or the debt side, my investors are typically getting in the 10-11% range, and again, those are monthly payments, and then you get your capital back at the end. So I feel like that's a pretty solid place to park some money right now. As far as the deal that I was involved with at the beginning of the year, is a multifamily deal. I approached it, Brett, the same way I approach every deal. I have a pretty disciplined approach, and I actually break it down into what I call the safe investing method. And so SAFE is an acronym. Of course, investing isn't safe, so don't come to me, shaking your finger at me later and say you said it was safe. No, SAFE is an acronym. S stands for sponsor. So you really want to do your due diligence on the sponsor, ask lots of questions. If they pass that, then you go to A, which is asset. What is the asset that you're actually investing in? Where is it? Is it in a good market? Are the jobs growing there? Is the economy growing there? And then F is financials. The financial projections realistic? What are the tax implications? What are the return metrics looking like? And then E is for exit. How do you get out of this thing? It's not like you can go to schwab.com and click and sell your position in any kind of syndicated fund deal. It just doesn't work that way. So as an investor, you need to know going in how long your capital is going to be tied up and what needs to happen for you to exit successfully and get your money and your return back. So that's kind of how we approach everything. But the deal I did in earlier this year was an apartment complex in Phoenix, a neighborhood northwest of Phoenix. Great market. Well, first of all, right, start with S, the sponsor. Great sponsor, experienced sponsor, great track record, great reporting, financial reporting for investors. They have that clarity and that transparency, which is super important. And then again, personal relationship. These days, I've been at it long enough. I really only invest with people that I have a personal relationship with. I can pick up the phone and call them or text them or whatever. I can get direct access to them, which is very valuable. And then A, the asset was a really solid multifamily property in the great neighborhood. A lot of investment dollars going into the Phoenix area. So that's really helping to support that economy and keep jobs flowing there, keep population flowing there, which of course drives demand for housing. And then, the financials looked very reasonable. In fact, they were, at the time they closed on the deal, they were already running at year 2 financial figures, which is great. I love to see that the operator is conservative in their projections, because that's how I would do it. It's how I was taught long ago to put these projections together. And then as far as the exit, it's pretty good bet, in my opinion, that Phoenix is going to continue to be a strong market. And so in 3 to 5 years, as they're executing on their operations plan, which was a pretty low risk plan, in my opinion, felt like they could generate some pretty solid returns for myself and my investor partners.
Excellent. So Tom Dunkel, everybody, want to learn more, you can go to eaglecapitalinvestments.com, eaglecapitalinvestments.com. Yeah, I like all of that. I think that all makes sense. I like the strong reporting, great financial reporting, and I like that it's personal relationships. And then I'm also finding, we did one recently about 9 months ago. It was on the basis, right? Because still interest rates and cap rates, a lot of the going in caps are, still 5 and 6s, maybe get some 7s, but interest rates, it's either even at par or negative arbitrage, but you might still have a little bit of cash on cash return, but you're buying on basis and you're saying, look, in a couple of years, yeah, it's going to average out. It's tough though when you have such double-digit returns on these debt cash flow. I'm finding that most people, Tom, want what's called truly passive cash flow. Like the older we get, and the older the baby boomers get, they're just like, you know what? Just give me some pure cash flow. And I call this no shoes, no shirt, no problem. You're Kenny Chesney sitting on the beach and you're playing your guitar and you want the 10, 20, 30, 40, 50,000 passive per month. And at the end of the day, you're like, you know, if you give me that now, like, I don't have to wait around for this, like, this changes everything for me. And we believe that truly passive income is to your freedom and impact as compounding interest is to your money. And the problem is, the number one mistake is they have diluted focus, so they get diluted results. Mm-hmm. And I think one of the biggest lowest hanging fruit is to help investors focus like a laser on that number. Like, what is that number for you? And then like, where do you get that passively, right? Because the whole rich dad, poor dad thing, I just think I love Robert Kiyosaki. I love the Purple Book, all that cool stuff. But like, who actually gets to that fourth quadrant, right? It's like, it takes a lot. And so, anyways, I'm just finding my word of the year, Tom, this year is urgency of time. Basically, time and urgency, right? It's kind of a 2 words, right? But urgency could be it. And it's like right now, if you can unlock that truly passive income, get that number, and then anything above and beyond that can go make an impact and help more people. Mm-hmm. Anyways, those are just kind of my philosophy there, which leads me towards more like double-digit returns. Yep. Versus the 5% stuff that's just like, I'm like, hey guys, call me in a couple of years. I get it. We got one at 68,000 a door. Like the basis was so low that we said, we'll take the 5% for a year or two. And then, cause we know we're pretty confident in 3-4 years, we're going to sell it for 120 a door. If that makes sense. Yeah. Nice. Any thoughts on that? Or I don't know. Am I way off, Tom? Am I way off?
No. I'm all about a beer in Mexico myself. So I've been shifting my portfolio definitely more towards current cash flowing opportunities, as long as the capital preservation is there, because there's tons of LPs and sitting around right now who were promised these pref payments from deals that they did in 2022, 2023. And they're not getting them, right? And you know, we ran into that, to be honest, in our storage business, which I transitioned out of last year. But we had put deals out there like, hey, we're going to be paying 5-6%, and then the market changed and shifted, and sadly we weren't able to continue to do that. So that's why I prefer to be in cash flowing deals that are cash flowing really well right away, like you were saying, high single, low double digits. And so that's been where I've been focusing my energy for sure, because it's tough to go wrong when you're getting those cash payments every month, right? You can help build up that toward that financial freedom number if you're not already there already. And then I love what you said too, Brett, about then you're able to turn around and start really making an impact on your community or on the causes that you really feel strongly about. So I love that.
Absolutely. Yeah. Thanks for sharing, and thanks for going back and forth on that one. What else? What else are you seeing? Anything out there that's kind of unique or interesting? I know we have the big, beautiful bill that's got passed and the 100% bonus depreciation. So it's coming back. So what are your thoughts? By the way, before you answer that, I also think part of what drove the craziness of the prices of the multifamily and self-storage world a few years ago was not just low interest rates. It was a perfect storm of still having 100% bonus depreciation, right, at the time. And then you add it just the rapid rent growth, right, that was happening. All of these things are I try to remember, I also started in 2006 in the Marcus and Millichap, and I saw all of it. Mm-hmm. And I think we did pretty good these last few years. We've had some, like you said, some deals that didn't work out, but a very small percentage of the portfolio for how we manage Deferred Sales Trust for clients. But the point is, it's like debt flow, this is what I'm taking it, tax flow and cash flow. And most people, or most of us, are so focused on cash flow, which of course it includes after the debt payment and everything. But I think you really got to separate the three. You got to have cash flow now. You got to have debt flow, don't take for granted that interest rates are going to be low forever, right? I had people saying that before. And then you got to have tax flow, right? And you got to realize that, okay, if tax flow is at an all-time high with these 100% bonus depreciations, that's driving these deals to these higher marks. If cash flow has been rapidly growing for so long, and then your debt flow is at all-time low interest rates, it should almost be like, instead of like green light, go, it should almost be like caution, yellow, like move back, take a step back, right? And so, but now people are getting crushed. I mean, they're losing I call it the year of the tap out. It's the year of the commercial real estate jiu-jitsu tap out. And they're finally like, okay, interest rates aren't going down. They're in this arm bar for the last year. And they're like, okay, and this 100% bonus depreciation is not going to save them. By the way, it's a step in the right direction. Rents are basically flat for a lot of places, and now they're just like, give it back to the bank. But I mean, am I missing that, Tom, or is that the same you're seeing?
No, I think that's spot on. I think a lot of people for a long time were saying, "Oh yeah, we're definitely going to have these rate cuts." I don't know. I felt on the other side, and I'm no super economist or anything, but I saw there was a lot of heat in the labor market that was really kind of keeping that inflationary, and was not going to allow the Fed to cut rates without really cranking up inflation, and then who knows what would have broken loose at that point. But I've been feeling for a long time that we're sort of in this slaggy period. I don't know if that's a word, but I like it. Slaggy period where there's not a lot going on right now. Not until, the labor market kind of figures out where it's going, the economy as a whole figures out where it's going, or if we are heading into recession, is it going to be short? Is it going to be long? So I feel like we're in this hold period right now where it's just kind of hold on, survive and wait to fight another day in the future, because as we all know, anyone who's been around real estate for any period of time, that it goes in cycles. And so you just kind of got to hold on, do the best you can with the things that you can control, right? We don't have control over interest rates or the Fed or tax policy or anything like that. So we just need to be able to navigate as best we can, pull on the levers that we have at our disposal and just try to make the best of things right now. But again, that's why I lean back towards those fix and flip, private lending opportunities, because I just feel like in the right kind of market, those housing markets, the places where I do my private lending are still, pretty robust markets. Properties are moving, and so the exits are happening, and I'm getting paid, and I'm secured. I like that. So until I start seeing things, really breaking, strongly more into owning the property, I'm going to kind of hang back and bide my time until that point, because I agree. Rents are not really going anywhere. In our self-storage company, we feel like rents have bottomed out and they're starting to come back, but it's a slow go. And so I feel like that's the same in a lot of multifamily markets as well. The rents have dropped, and now they're starting to either flatten out or maybe the curve starting to bend back up. But it's certainly no hockey stick, and it's going to take a little while. On the bonus depreciation side, we do have one of the businesses I'm involved with is a short-term rental company, and we're looking at the bonus depreciation going back up to 100% as an opportunity to do some expansions there. So we have houses that we're doing these short-term rentals, the Airbnbs, where if we add a bedroom, or if we add 2 bedrooms, or maybe we add a story, or maybe we tear something down and build something back up, we can get better economics. And now with that bonus depreciation back at 100%, those deals are penciling much better now.
100%. It definitely is a step in the right direction, and it helps. And gosh, I'm really spot on everything you're saying there. So, okay, good. All right. By the way, so recently you looked at the Deferred Sales Trust. I'm just kind of curious, maybe we can cover this a little bit, right? Mm-hmm. You're experienced in the industry, right, for many, many years. And what did you like? What was not as great? Mm-hmm. Give us your assessment. I think this would be good for everyone to hear.
Sure. So the Deferred Sales Trust is something I've been hearing about from time to time as a alternative kind of exit strategy when you have a property and maybe it's appreciated in value and you're looking at a big exit, which might mean you're also looking at a big tax bill. it was something that I had heard about and really just in the last, few months started learning more about it. But to me, obviously the deal has to be the right deal. And so you have to have a pretty healthy capital gain that you're looking to protect in order for the strategy to kind of make sense and pencil out, because there's costs involved, right? And that's fine. But for the deals that I have and that I have with some other partners, it didn't work because our gains were not really at the level where a deferred sales trust was going to make a lot of sense. And in our distressed mortgage debt business, I was looking at that because in our distressed mortgage debt business, we get creamed with taxes because we're considered dealers in that business. And so everything is taxed as ordinary income, which is at the highest rate. And so when I started hearing about deferred sales trust, I was like, I wonder if a deferred sales trust could be helpful when we're liquidating our portfolio of loans. But each one is its own separate asset. And so it made it kind of unfeasible to use that strategy. So we're kind of looking at some other things. But I mean, if you are a guy out there and you got a big tax bill coming because maybe you've inherited a property from a family member, or maybe you bought something back in the 80s or the 90s, and you've been holding on to it for all this time, and you got a big tax bill coming up. I mean, I would definitely take a hard look at the deferred sales trust because, let's face it, it's sad but true. The biggest expense that we all have in our lives is taxes. And so if you can, minimize that or spread it out or, otherwise manage your exposure to a big tax bill, I mean, it's definitely something worth taking a look at.
Awesome. Thanks for sharing, Tom. People want to learn more or get started, you can go to capitalgainstaxsolutions.com. That's what we specialize in, is the deferred sales trust and building capital gains tax exit plans for your Bitcoin business or real estate exit. And Tom's exactly right. It needs to be at least $1 million net proceeds, $1 million gain, generally speaking, to make sense. If you had two at 500,000 each, you can do it. And there's some things there. So just the larger sales, larger gains, it can be amazing. For anything smaller than that, it's generally not worth the trouble. But that being said, we also have a book called Building a Capital Gains Tax Exit Plan. You can check that out on Amazon or go to capitalgainstaxsolutions.com. Cool. Tom, we're running out of time. Are you ready for the lightning round?
Yes, sir. Bring it on.
All right. Knowing what you know now, if you go back to your 20-year-old self, what's the one gold nugget make sure to tell yourself to do?
Oh man, I would go back and I would really try to instill in myself the confidence to leave corporate America sooner and get out and chart my own course earlier. Because even though it's been hardly a straight line, Brett, there's been a lot of ups and downs, a lot of failures and heartache and tears and sleepless nights and all that stuff. But there's been a lot of successes. And the other benefit too is it's allowed me to really be a part of my kids. When they were growing up, I was, helping them out with the coaching and the scouting and the, being at their school and all that cool stuff. So it really added to my my lifestyle. So I would go out sooner.
Love it. Love it. Question number 2, what's the number one book you've recommended the most in the past year?
There's a book of mine, and it's a little different. I know a lot of guys are, throwing out business books and stuff like Who Not How over my shoulder here, which is a great book. But my favorite book, Brett, is a book called The Last Place on Earth. And it's not a business book. It's not a finance book. It's not a real estate book. It's actually a book about the race to discover the South Pole. And it actually ends up being a great book about leadership and about planning and about humility and all kinds of cool things. But it's just such a cool adventure story as well. So The Last Place on Earth, I encourage anyone to read it for a little something different.
I'm going to read it. This is cool. I love it. I'm going to buy it right now. Next question. Number one way you're using ChatGPT.
Oh man, I am using it for just about anything these days. I'm actually copying and pasting contracts in there. So I'm negotiating contracts using ChatGPT. I'm using it to help with marketing and copywriting, things like that. And the most recent thing, and I'm still tweaking it, but if folks do go to my website, eaglecapitalinvestments.com, you can actually chat with me, my AI clone, and you can learn all about my background and Eagle Capital Investments and what we do for our investor partners.
Love it, love it, love it. Next question. Number one leadership quote or theme that you strive to live by?
Try to live by an oldie but a goodie, which is if you give a man a fish, they eat for a day. If you teach a man to fish, they eat for a lifetime. I love to help people. I love to, especially at this point in my career, Brett, I'm trying to get these things out of my head and out into other people's brains so that they can take advantage of my experience, my failures, my successes, and hopefully they can help avoid some bad stuff.
Absolutely. Tom, it's been more than a pleasure having you on the show. I want to thank you for sharing your insights, your wisdom with us, and just kind of diving in a bit more in the marketplace. And for those who want to get in touch with you, one last time, what's the best place for them to find you?
Sure. I would encourage folks to go to investwitheagle.com, where you can grab a copy of my book and learn about the SAFE method, which we talked about earlier, and as well as some other anecdotes and stories about my journey.
Awesome. Thank you, Tom Dunkel, for being here. And also thank all of our listeners for listening and or watching the Build It to Billions podcast, also on Capital Gains Tax Solutions podcast and YouTube channels. We're here on this mission to scale from millions to billions so we can give more all of it away to help MVPs. And we're on this journey, and we want to encourage you to take action today and level up your investing and your impact. Appreciate you watching or listening today. Please rate, review, subscribe, and we'll talk to you again. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.